So you can see the difference is great in terms of variety. Hi guys, it's Eric from Hong Kong based in Germany. I've been investing since I was 17 years old for almost 20 years. I want to give you guys alternative perspective about investing in Asian stocks with local insights as well as in personal finance. Today I want to talk about how to invest in Chinese stocks. Or if you have no idea why on earth you should invest in Chinese stock at all, look at my video before. But of course, before we know about how to invest in Chinese stocks, the first thing is, what can we invest? What do you mean by what? Isn't it just like in the US, you have ETFs, you have mutual funds, and you have stocks, and that's it, right? Well, yes and no. For mutual funds, as I mentioned, the costs are high. For example, at the very beginning, there's something so-called subscription fee, which could cost up to 5% of your invested capital. So before you even started investing, you already lose 5% of capital, and it will have a huge impact for you in the longer term. Secondly, they have the annual management fees, which could range from less than 1% if it was some very simple index funds to up to 2% or even more per year. So in the short term, of course, it's not good if you're trading frequently and you have these kind of costs. And secondly, in the long term, it's also bad because this kind of percentage might not seem very high, but if you compound over time, it could add up. Let alone that mutual funds are much less liquid, meaning it's much less frequent that people will actually buy or sell. That means it's harder for you to buy and sell as well. Imagine if the mutual funds return last year was 5%, which is not very unusual, and you have a 2% management fee per year on your invested capital. That means in this year, you will pay up to 40% of fees to the fund managers for your return. The second way to invest is through ETFs, equity traded funds. So basically, this kind of funds mostly are index ETFs, which means they just track the index by buying the stocks included in the index and according to the weight of those indexes. So there's no active management going on, and the fees could be as low as 0.something%. And of course, there are usually no subscription fees. And other good thing about it is that they are more liquid, meaning is that they are traded on the stock exchange, and during the trading hours, there are many people buying and selling. So it's much easier for you to buy and sell in real time during the trading hours. Instead of like mutual funds, you need to wait for at least 1 day or 2 days or even 1 week sometimes. Furthermore, interestingly, some of the ETFs that are China focused, they do not even buy shares in mainland China. For example, in A-share, which I will explain a bit more later. They are just buying the top stocks in Hong Kong, and that's it. So everyone could trade in Hong Kong anyways, so why don't we just buy directly instead of waiting for them? At least we have more control, because in ETFs, one of the downsides is that we do not have control of the portfolio we have. We just depend on the index. I have a separate video about ETFs, so remember to click the subscription button now and click also the bell button so that you will get notified when I make more videos about it. The third possibility to invest in Chinese stocks is directly investing into Chinese shares. This is actually better than ETFs because you have full control of the shares that you're going to invest in instead of just rely on an index. And the interesting part is that there are actually many types of shares that could be invested or cannot be invested by foreign nationals, which is quite different from the US or in Europe. Because if in the US or Europe, you would just go, okay, there's a share listed on stock exchange and that's it, I buy it. But in China, partly attributed to the fact that the Chinese yuan or RMB is not an exchangeable currency, or at least not freely exchangeable. So that's why there's so many types of shares. But no need to worry, I will summarize and recommend to you guys the best kind of shares you should be investing in and which kind of shares to avoid. But for now, of course, I need to explain the background to you guys and then so that you can understand the rationale behind. So first of all, A share and B shares. This kind of companies listed on as A share or B shares are incorporated in China and are both listed on stock exchanges in mainland China. for example in Shanghai or in Shenzhen. So what are the differences? A shares are quoted in Chinese yuan or RMB, and B shares are quoted in foreign currencies. In Shenzhen, that means Hong Kong dollars, and in Shanghai, that means US dollars. And as a foreign investor, unless you're a billionaire or you're an institution like JP Morgan, A share and B shares on mainland are basically off limits. Of course, there are some schemes like QFII, Qualified Foreign Institution Investors, which they have a mechanism for institutions to invest, like your pension funds or mutual funds, or even ETFs. But funny enough, some of the biggest ETFs, they do not own any share in mainland China. They only invest in Hong Kong, or they doing some kind of swap agreements. But I will talk about ETF in a separate video. Thirdly, we have H shares. H shares are basically companies incorporated in mainland China but listed in Hong Kong. And then the fourth type is red chip, and then fifth type is P chip. Both red chip and P chips are incorporated outside of mainland China, but also listed in Hong Kong. So what are the differences between P chips and red chips, right? Red chips are basically companies that are state-owned, and P chips are non-state-owned companies. You certainly do not have this kind of distinction in the US or in the UK, right? At least there are not so many state-owned enterprises. And then we have the sixth type of stocks, ADRs, American Depository Receipts. Well, basically, a bank or a broker hold the underlying stocks of the overseas company, and then they issue the ADR in the US so that it's easier for guys to just buy and sell. In reality, it's quite complicated. You don't actually own any assets based in China. And then there's a seventh type of Chinese stock, which is basically the Chinese business listing directly in the US or in other countries. But this is not the majority, and the number is relatively small. As a normal foreign investor, unless you're a billionaire which you have direct access into China, which is extremely rare, or an institution like JP Morgan, which of course you can QF2 to invest in mainland China. In most cases, you can either invest in Hong Kong Stock Exchange, which is open for all nationals, or in ADRs or in some kind of stocks that is directly listed on the US. ADR is relatively easier if you are based in the US, but buying that, there's a risk. First of all, the ADR does not represent actually the assets in China. And secondly, there's the risk about the tension between US and China, right? If you remember a few months ago, there was some delisting of companies like China Mobile, China Unicom from the NYSE. Also, the choice is limited. The number of ADRs are 241. But if you compare with Hong Kong Stock Exchange, there are 2,552 stocks listed in Hong Kong. So you can see the difference is great in terms of variety. So if you want to invest in Chinese stocks, it makes the most sense to invest directly into the Hong Kong stock market, because the best companies in China are basically all listed on Hong Kong Stock Exchange. And foreign nationals are free to trade without any restrictions, and also free to move their money in and out of Hong Kong, which is not the case in mainland China. Also, it has a world-class financial infrastructure and regulatory regimes, and it's even better if you are from the US, because Hong Kong dollar is pegged to US dollar. That means that there's no exchange rate risk. Okay, all sounds really good. And then you may think, okay, but I don't have access to Hong Kong stock market. Is it true? Think twice. Actually, most of you have access to Hong Kong stock market. If you are from the US, Interactive Brokers, Charles Schwab, Fidelity, etc., all these kind of big brokers allow you to open an account in Hong Kong, or you can even approach their branches in Hong Kong directly. Secondly, you can open an account with Hong Kong brokers. I mean, we all speak English. As you can see, I'm from Hong Kong. We are educated in English, so language is not a barrier, and you're free to move money in and out of Hong Kong. and you can exchange for Hong Kong dollars as well, which is something that you cannot do with Chinese yuan. And if you are from Europe, for example, the Netherlands, Germany, the UK, you have access to Hong Kong with very low fees with e-brokers. For example, eToro, Trade Republic, Tegero, all these kind of e-brokers, they offer you guys to buy stock in Hong Kong without any fees or at very low fees. So access is totally not a problem. So it's pretty obvious from the above analysis that what type of Chinese stocks you should be investing in. If you're investing in Hong Kong, it's easy and cheap. The next step is to actually consider what kind of stocks to actually. Of course, I'm not a financial advisor, and this is just for educational purposes. But I will very much happy to share with you my analysis about some interesting companies. So if you want to know about it, remember to click on the bell button on the right side below of the video so that you will have the latest information and the news from me. What do you think about it? Are you going to invest directly into Hong Kong, or you're going to invest in ADR? Let me know in the comments below. If you like the video, remember to like it, share it, and subscribe. Even better, clicking on the bell button. This will be great motivation for me to make deeper analysis and better videos.